H&R Real Estate Investment Trust still down almost 40% from their February highs. And if we look at this chart dating back over 20 years, we can see that H&R is trading at historically low prices. Given the nature of the company, they did experience a fairly big sell-off in 2008, but recovered over the next few years and has been fairly steady throughout the low to mid 20s range. Hello and welcome to the Financial Future Guide. I'm your guy and I'm your guide. My name is Alex and it's good to be back after a couple weeks off. I hope you all had a great Christmas holiday and took some time to kick back, throw your feet up, and check your portfolio 10 times a day, even when you know the markets are closed. Today we're looking at H&R REIT, which can be found under ticker symbol HR.UN.TO on the Toronto Stock Exchange. They currently pay a 5.15% dividend, which equates to 69 cents Canadian per share. Before we get started, just a reminder that I am not a financial advisor and you should do all your own research before purchasing any stocks shown on this channel. And full disclosure, I do own this company and am long this company. We got a bit to cover, so let's get started. H&R is a real estate investment trust that is focused on the North American market. They own just under $13 billion worth of assets, with just under half located in the United States and with the remainder located in Canada, predominantly focused in Ontario. So H&R does have this interactive map on their website in which you can see where all their properties are located. And what I take away from this is they are exposed to multiple countries and multiple areas of each of those countries. However, there still is a lot of room for growth, and I definitely do expect them to continue to move into these additional markets in the coming years. It's also really cool to see that if you zoom in close enough, you'll actually be able to see yourself hit the like button. The company holds a diverse portfolio of 466 properties, and this is made up of 33 office properties, 325 retail, 86 industrial, and 22 residential properties. Over the past 5 years, H&R has been changing up their portfolio profile with a big focus in diversifying into the different sectors of the real estate market. Multi-residential properties account for now 23% of their portfolio, up from 1% in 2014. Over the same period, retail decreased from 39% to 28%, office decreased from 51% to 40%, and industrial has remained at approximately 9%. Now, I like the company and I also like the management. When investing in a company, it's always important to look at the management, as they will ultimately be making the decisions that dictate the future of the company. We will get into a bit more detail of the management shortly. Looking over here at the stock quote, just take note that all the numbers here are in Canadian currency. And today the stock closed at $13.39 Canadian, down 2 cents on the day, or 0.15%. They have a market cap of $3.841 billion. And given that the PE ratio is a negative, it is displayed here as not applicable. Now, as we've discussed previously, a PE ratio is not the best way to evaluate a real estate investment trust. Instead, it's best to look at the funds from operations, because this looks at the cash flows of the company. And in real estate, it's important to be focused on the money that's coming in from the tenants as they pay their monthly rents. And following on from that, earnings per share is also shown as a negative over the last 12 months. This stock was hit hard during the start of the pandemic, and thus the stock's prices ranged anywhere from $7.39 to $21.88 Canadian. As I mentioned earlier, they are paying a dividend of 69 cents Canadian, which equates to 5.15% of the current stock price. Now, taking a look at the dividend growth and history for HR REIT, the company was growing the dividend quite substantially as they moved out of the 2008 financial crisis. However, it has remained fairly steady from about 2013. Now, although this chart does show a huge drop in mid-2018 where it seems that the dividend was cut or not paid, in reviewing the dividend payouts, there was no month missed in 2018. So back in 2010, the dividend was 72 cents Canadian per share, which equates to 4.3% of the stock price at the time. And in March 2020, when the stock price took a big hit, the dividend yield actually crept up to the 8.9s. I think it even hit 10 at one point. However, they did cut this by 50%. So as we saw previously, the dividend is now 69 cents, which equates to 5.15% of the current stock price. Now, as always, it's important to know if the company is going to be able to continue to pay out this dividend. We need to look at the payout ratio according to their funds from operations. So here, if we look at their AFFO, which is the adjusted funds from operations payout ratio, they're paying out 49%. So there's plenty of room to grow the dividend. But also, as we're not quite out the clear yet in terms of this pandemic, it is good to see that the company is retaining some of their cash in order to protect the financial security of the company. Now, Simply Wall Street, which is a great tool for all investors, offers an estimated fair value based on the cash flows the company is expected to generate in the future. The fair value that they have for H&R REIT is $39.56 Canadian, which means they're currently about 66% undervalued. Now, as always, we like to look at the price to book ratio, in which companies that are below 1 could be potentially viewed as undervalued, whereas those with a higher price to book ratio may be trading at a premium. In the case of H&R REIT, they're currently trading at a 0.6 price to book ratio, which is slightly below the industry of 0.8. However, I always think it's better to take a few case studies and look at some of their competitors. So on the retail side of the business, we'll look at RioCan, which is currently trading at a 0.7 price to book ratio. And then on the residential side, we'll look at Canada's largest residential REIT, Cap REIT, which is currently trading at a 1 price to book ratio. According to this metric, H&R is trading below its value, and it's also good to see that it's trading below some of its competitors. Next up, we're going to look at some of the recent insider trading. Now, this is something I always like to bring up, and I do put a big importance on, because I see value in knowing what those that are a part of the company, working day in and day out within the management team, think of the company at the prices that it's currently trading for. If those that are within the company believe that they're overvalued, they're likely to get rid of some of those stocks, sell off for a profit, whereas in situations like H&R, where we see many of the insiders continuing to buy, it's very positive to see that they believe the company is undervalued and they're willing to put their own capital behind it. Next up, we'll look at the management, and for management, I want to focus on one individual particular, Thomas J. Hofstadter. He is the president and CEO of the company, and he has more than 40 years experience in the commercial and residential real estate sector in North America. He began this position in the end of 1996, and him along with his management team have put together a strong strategy to help with acquisitions and selective developments in the North American real estate market. Now, Thomas Hofstadter is paid $3.85 million annually, but more importantly, he has $49.5 million of his own money invested within the company. And this definitely shows us that Thomas the bank engine is putting his money where his mouth is and acting in the best interests of the shareholders, or as I like to see us, owners of his company. Some key points we can see from this page is that H&R's rent collection improved from 90% in Q2 to 93% in Q3. And this is mainly driven by the retail collections improving from 72% to 80%. H&R's provision for bad debts, which essentially is money they put aside to account for people who are unable to pay their rent, was $13.4 million, which is down quite substantially from $24.5 million in the previous quarter. Now, the next 2 points are FFO and AFFO, and these just refer to funds from operation or adjusted funds from operation. I personally prefer to look at the adjusted funds from operations, as it considers things such as the maintenance costs, and it deducts any recurring expenditures required to keep the real estate property running and generating revenues. Now, the AFFO was 35 cents per unit, which was up quite a bit from the 29 cents per unit in the previous quarter, and in line with where they were in Q3 of 2019. And as we discussed earlier, that dividend is nice and safe, with a payout ratio of 49% of their AFFO. Now, it's positive to see from Q2 to Q3 and then even into October, the rent collection continued to increase. This is obviously very important to focus on with a REIT who derive the majority of their cash flow from rent collection. Their office portfolio has a 99.6% occupancy rate, which is very strong, and the average remaining lease term is 11.7 years, which means cash flows for their office real estate is fairly predictable for the foreseeable future. Retail, on the other hand, only has an occupancy rate of 91.5%, and although this is slightly lower than we'd like to see, the overall strategy from the REIT is to diversify away from being so retail focused. So although I would like to see this increase slightly, at this time I'm not too worried about it, given everything going wrong in the retail sector at the moment. This pie graph here breaks down their retail segment into the percentage of gross rent per industry, and although it is good to see that they are quite diverse, I would like to see them decrease their exposure to the fashion segment, as this does make up a fairly large portion of the portfolio, and I personally believe clothing is some of the easiest things to purchase online, and I would expect retailers that are currently tenants to take a hit from the large e-commerce market. Next up is the industrial portfolio, which currently has an occupancy rate of 97.5%. They currently have 86 properties in the industrial space, and the majority of those can be found in Canada. This space is one that I am very bullish on given the growth of e-commerce, and I think that the need for industrial real estate is only going to increase in the coming years. So it does make me very happy to see that H&R is continuing to invest in this sector, and as we can see here in their current developments, they have approximately 144 acres of land which is being held for development, and this is expected to provide about 2.7 million square feet of industrial space. Now what I actually like most about this is that these 144 acres of land is in Caledon, Ontario. Now for those who have no idea where Caledon is, it actually borders Brampton, which is very close to the Toronto area. Being a high density area, I think this will be an incredibly value asset to the H&R portfolio. Finally, the residential portfolio, where they have 7,777 residential rental units available, and they don't show the occupancy rate here. However, the average age of the properties is just under 6 years, so they're fairly new buildings. And if we have a look at what H&R are working on at the moment, these are very attractive buildings in high quality areas such as Miami, Florida, Long Beach, California, San Francisco, and Austin, Texas. These are all areas that I think will continue to experience growth, and I expect their residential portfolio to continue to grow and flourish. So in closing, for H&R Real Estate Investment Trust, I'm a fairly big fan of their portfolio. I like how the company is positioned and the strategy that management has in place for their future growth. I think they're trading far below their value, and I was actually fortunate enough to pick up the company below the $9 mark at its March lows, and I've been continuing to add to my position over the last few months. Even with the recent run-up, I still believe the company is below value and will be continuing to grow my position into the future. So tell me, do you think this company will return to its previous glory days when it comes to its stock price? Are you looking to buy this company? Do you already own it? I'd love to hear from you in the comments below. Now that's all for today's video. Remember to like, comment, and subscribe to see videos similar to this one.